Billionaires are undoubtedly masters of money. It's no coincidence that these few individuals concentrate a significant portion of the world's wealth. Some of them have built their fortunes through extremely valuable businesses that have transformed the lives of thousands or even millions of people. In addition to their ability to multiply resources and profit greatly from it, billionaires also have access to a detailed understanding of how to protect the wealth they've amassed, not only from internal and external factors but also from the government. Assisted, of course, by the best accountants, lawyers, and financial planners, billionaires have access to financial and tax information that literally makes them even richer, while the poor become increasingly poorer. This is because they can legally evade taxes. Many taxes, in fact. And not infrequently, mega-entrepreneurs like Elon Musk, Jeff Bezos, and Warren Buffett manage to pay less in taxes than you and I do. Sometimes, when it comes to income tax, even zero. Yes, you read that right, zero. And no, it's not through any threats or shoddiness. The world's wealthiest people can satisfy the wildest and most unlikely desires that money can buy, all while avoiding paying taxes, a fact that would make any anarcho-capitalist proud. To give you an idea, between 2009 and 2012, Elon Musk didn't pay a single cent in income tax, just as he paid no federal tax in 2018. Similarly, Jeff Bezos achieved the same feat in 2017, as did Donald Trump and other billionaires in some years. But how do they manage this? How is it possible to amass a billion-dollar fortune and not pay tax? This video is not meant to discuss whether this is right or wrong, as the debate on taxing billionaires can lead to different outcomes and would deserve a separate lengthy video. For you, do you think they should or shouldn't pay more taxes? In any case, let's focus solely and exclusively on how billionaires manage to avoid taxes. This mainly happens because the vast majority of governments, including the American government, focus tax collection on people's income rather than on their wealth. As a result, billionaires do everything they can to avoid taxable income, such as salaries, for instance. They instead invest in accumulating assets and employ other strategies that steer clear of the taxman's appetite. In practice, they essentially tell the world, if the government taxes income, that's fine, we don't have income. Along these lines, it's common for some billionaires to have a zero salary, even if they are advisors or executives of their own billionaire companies. Alternatively, instead of a salary, they may be compensated with shares in companies in which they are partners or owners. Moreover, they often include their personal expenses as expenses of another company or foundation they own. This, in practice, turns their expenses into expenses of a company, and the company itself covers these costs. Here in Brazil, for example, some billionaires don't receive a salary, or if they do, it's kept to a minimum. In exchange, they receive periodic dividends from their own companies, which, up to this point, are not considered taxable income. This strategy is not valid in the USA, where dividends are subject to about a 30% tax at the source. Nevertheless, American billionaires seek other alternatives, further strengthening the buy, borrow, die strategy, which can be used in most jurisdictions around the world without significant issues. Through this strategy, the super-rich begin by purchasing assets such as real estate, stocks, and other long-term investments that form their wealth, which constitutes the first element, buy. These assets are subject to depreciation over time, and the expenses they generate over time are used as a depreciation factor. Another factor is the inherent depreciation of the asset itself, which is the loss of value over time, like a car that tends to lose value year after year, or a property whose registered value is not updated in the tax return over the years. Even though some of these assets may have a market price that appreciates over time, this higher price is only adjusted and reported in the income tax if the owners decide to sell the assets. While these assets remain part of the billionaire's wealth composition, they continue to proportionally lose value year by year. Because of this, in most cases, billionaires do not directly sell the assets they own. Instead, they either keep them or use these assets as a means of exchange for acquiring other assets. This is because selling the asset could result in heavy taxation by the government, which they want to avoid. However, despite this first point being an interesting way to protect their wealth, it runs into another problem. Billionaires need money to purchase what they desire, and that's where the second point comes in. Borrowing money, the borrow. Since they avoid taxable income sources, such as salaries and dividends, billionaires generally choose to borrow money from banks to acquire extravagant items like houses, yachts, supercars, and other luxuries. They may even borrow money to acquire other businesses, as Elon Musk recently did to purchase Twitter. In any case, borrowing money is an intriguing way to have cash on hand without having to give a portion to the government. This is because billionaires don't just take any kind of loan, they self-finance by offering their own assets as collateral. This can include real estate, cars, or even their own shares in the companies they own. Instead of simply borrowing the desired amount from banks and paying it back with high interest rates later, they offer their assets as collateral to banks, thus obtaining loans at extremely low interest rates. Banks can seize the assets provided as collateral in case of non-payment. While this type of loan incurs some interest costs over time, the interest is lower than what they would pay in taxes if they conducted regular buy and sell operations or received traditional sources of income, such as a high salary, for example. To add to this, it's common for these loans to be rolled over repeatedly, with new financing, new collateral, and even long grace periods for starting repayment. Not uncommonly, they also indirectly exchange the loans for some of their own shares directly, not as a purchase and sale operation but simply by not paying the debt they've assumed, so the loan itself absorbs the shares provided as collateral as a form of payment. In other words, they have a lot of money on hand without having to pay taxes. Furthermore, there are cases in which banks also facilitate access to money in exchange for preferences and facilities for future operations of these billionaires' companies, such as participating in a future initial public offering or fundraising operation in the financial market. In any case, regardless of the option chosen, billionaires stay off the government's radar and taxes. If they incur costs in this operation with banks, it is much lower than simply giving money to the government. In other words, more money for them and less for the state. Finally, the last step, dying. One of the biggest sources of income for governments is the tax paid by heirs. Here in Brazil, for example, property transfer taxes are state level and can range between 2% and 8%. Often, after receiving the property and paying the transfer tax, you may still have to pay income tax on capital gains if you sell the received property and make a profit in the transaction. This is because the value of the property in the estate inventory is usually much lower than its actual value, and you have to pay around 15% on the profit resulting from this difference. Do you think this is fair? Do you think our taxes are well utilized? In any case, in other countries, the tax can be substantially higher, even up to 50%. In the United States, for example, it varies between 18% and 40%, while in Portugal, it's 10%. Here is where the billionaire's last strategy comes into play to evade taxes, not only in their lifetime but also for their heirs. In addition to the aforementioned tactics, the money and assets that make up billionaires' wealth are also protected by holdings, foundations, and other legal structures that pay lower taxes than an individual. Or they will only pay taxes when a portfolio asset is sold. These entities often make heirs partners while the billionaires are still alive. Upon the death of the holder, the heirs may receive shares, stocks, and assets. Generally, the assets they receive have nominal values that differ from their real values, and often the nominal value is much lower than the real value. This is where another bonus lies. In the United States, for example, this difference between the real value and the nominal value can be adjusted through what is called adjusted cost basis. When they inherit the assets, heirs can correct and update the past value to the present value. If they wish to sell the asset, they can do so without paying capital gains tax since, from an accounting perspective, there was no profit in the transaction. In other words, they can dispose of stocks and other assets without paying capital gains taxes, thereby avoiding inheritance tax and income tax. However, before worrying about potential taxes, heirs often inherit a virtually negative estate. This is because the debts incurred by billionaires are included in the estate along with the assets to be received. Many times, the total value of the assets, before the necessary updates, is lower than the value of the debts to be paid. This is because, if the estate's value is not properly updated over decades, theoretically, it can be lower than the value of the debts. If the estate is virtually negative, there are no taxes to pay. In other words, a billionaire can amass immense wealth while paying very few taxes and leave this wealth to future generations, who in turn pay little or no tax on it. Furthermore, regarding bank debts, it's also common for billionaires to assume personal debts that are extinguished upon the death of the account holder. These are debts that do not pass to the heirs. To achieve this, they also purchase insurance and other arrangements that ensure the debt does not transfer to their successors. In cases where it does transfer, the successors can choose to pay off the debts or simply allow them to continue and perpetuate the game initiated by their predecessors, thus maintaining the cycle, buy, borrow, die. And so the rich continue to get richer while the poor pay taxes on income and inherited assets. In any case, without passing judgment, this is the rule of the game. What do you think about this? Do you find this rule fair? Share your opinion with us in the comments.